Hi, and welcome to this week's look at the major news stories that have affected the markets so far. What are we going to cover today? Well, we're going to take a look at euro against sterling. That reached a 6-month high last Friday. Obviously, we're going to take a look at the inflation figures that have come out both in the US and the UK this week and the impact those have had on the markets. Then we're going to take a look at a forecast from the S&P500 that came out earlier in the week and see what's going on with that. And finally, we're going to take a look at the forecast for BRENT crude oil running the end of this year and into next year. So to start with, euro against sterling, and that reached a 6-month high last Friday. Since September the 1st, in fact, the rate has risen by more than 2%. And the price dynamics have formed an ascending channel, which you can see in blue on the chart. Now, the main drivers still appear to be news related to monetary policy, and the monetary policy aimed at controlling inflation and discrepancies between countries in terms of currency rates. Added to that last week, though, we had UK GDP figures come out, which were better than expected. An increase of 0.2% for the third quarter against an expectation of a 0.1% increase. So that's pretty good news. But there was no positive reaction for the pound. And in fact, as I've said, euro against sterling hit a 6-month high. So why was that? Why no positive reaction? Well, if you look at it from a fundamental perspective, one of the main reasons was that a lot of the positivity in GDP growth was attributed to imports, which are notoriously volatile quarter to quarter, whilst other key areas were in fact negative in terms of GDP. So you can see why there was cause for concern there. And the ongoing concerns that high rate policy of Bank of England could cause GDP to fall, particularly in 2024 as they really take hold. Definitely a fear in the market about that. So if the pound didn't strengthen off the back of this good GDP news, could the bullish trend continue? Well, look at a technical analysis perspective. The rate is near key resistance of 0.8735, which was support earlier in the year, could now become resistance. Also, the divergence on the RSI indicator shows that bullish momentum is weakening, and resistance from the upper border of the ascending channel has yet to be broken, or that was the case at the time when we were reporting this. So it may well have been vulnerable to a pullback. Well, it's currently sitting around the 0.8750 mark, testing the above resistance I've just spoken about. So clearly, there's a lot going on out there. With these types of volatile markets, where there are contradictory signals going on in the market, then obviously don't forget your risk management techniques. Secondly, we're going to take a look at inflation figures, and obviously hot topic across the markets has been for some time now. But US inflation news seemed to rock the market slightly earlier this week. Wednesday, we saw the US CPI data. That came at 3.2% against an expectation of 3.3% and a previous figure of 3.7%. And core CPI was equal to 0.1%, the previous of 0.2%. So good news. Certainly seem to be heading towards the 2% target. A lot of people saying obviously that minimises the likelihood of further rate rises. Off the back of that, we saw a sharp weakening of the US dollar. Again, lots of people thinking the rate hike cycle is over, thus obviously impacting the price of the US dollar. Now, the result was US dollar denominated assets increased quite nicely. Gold went up 1.2% to a resistance level of $1,970. Shares also increased. And in fact, the S&P broke its upper boundary of its channel. More on that in just a moment, the next video. And currencies rose in price, those that were paired against the US dollar. In fact, cable, sterling against the dollar, hit a 2-month high. So inflation falling, definitely having an impact. On top of that, Thursday saw the UK inflation data come out. So CPI there was at 4.6% against an expectation of 4.7% and the previous figure of 6.7%. Again, good news in terms of inflation in the UK. The UK government celebrating quite strongly. They've met one of their targets of halving it in this year. So it's achieving results, but certainly seems to be taking a little bit longer than over in the US. It did lead to a slight decline in sterling against the dollar after the previous day's increase when the US CPI figures came out. Take a little look at the daily chart. It shows that technically a rollback could develop into something more significant, as the rate is definitely near the upper border of the important downward channel, which we see in red. The resistance level for sterling against the dollar could well be seen from that psychological level of 1.25. Well, currently it's trading around 1.239, so a little way to go yet before we have a clear indication of what's happening. Okay, thirdly, we're going to take a look at Morgan Stanley analysts raising forecasts for the S&P 500 this year. So obviously, they said on Monday, we reported on Tuesday, that the price would reach 4,500 by the end of the year. Their previous forecast was 4,200. They said on Monday that the dollar will continue to remain strong. Well, it's obviously had a little bit of weakness after the CPI figures, and the price would further fluctuate around current levels, forming a consolidation zone. And now that basically means that a decline in the S&P 500 was not a priority scenario. They also said, obviously, that US CPI data will provide more information about market sentiment. In anticipation of those figures coming out, we did see reduced volatility on the S&P 500. Inflation news could provide more bullish momentum, no doubt about it, pushing the price up from the median line, which we see in blue on the chart, and may justify the Morgan Stanley analysts' statements that it may reach the upper channel this month. And boy, did it. In fact, we're currently sitting at 45.02. As I mentioned in the previous video, those inflation figures out of the States gave a bit of a fill-up to the US stock markets. It's also worth noting from the chart, from a more technical perspective, that the increasing local minima of A, B and C shows signs of demand strength. And the RSI indicates non-divergence, increasing a likelihood of a move to the lower border. Now, obviously, a little bit contradictory there, but the move we've seen since that CPI data up to 45.02 roughly now seems to show some strength in what those Morgan Stanley analysts were saying. They were obviously talking about at the end of the year. So are we going to consolidate around 4,500 now for the rest of November and into December? Will it last until the end of year? Nobody's quite sure, but interesting that we reached those targets pretty quickly. A lot more to come, I think, the S&P 500, and obviously, news-driven markets at the moment, so keep your eyes and your ears open. Okay, finally, we turn our attention to commodities, but more analyst forecasts. And that's the fact that Citi analysts expect Brent crude to reach $73 a barrel in 2024. Since the beginning of November, the price of Brent crude has dropped by more than 5%. Now, obviously, one of the main drivers to that is easing of concerns about escalation of military conflicts in the Middle East. I mean, according to the latest news, Reuters, for example, saying that Iran does not plan to fight Israel on the side of Hamas. Obviously quite a big statement. And obviously we've also had the UN Security Council resolution in place. So concerns that are starting to ease. Obviously still a terrible situation, but escalation hopefully becoming less and less of a possibility. On top of that, we also had growth in US oil reserves. Inventories rose 4% to 439.4 million barrels last week. That was from 421.9 million barrels the previous week, and is in fact the highest level since August this year. We've had concern about those inventory levels for some time. The fact they're increasing is lending a little bit of confidence to the markets. If you take a look at it from a technical point of view, the price has been in a downtrend. We can see that from the red lines you're seeing on the chart. November the 14th, the price tested the median line, which acted as resistance. But during this test, a bearish engulfing pattern formed itself. $81.81 may now serve as immediate resistance, whilst another important level of $84.50 a barrel, to be honest with you, appears out of reach currently, and certainly for November. Now, if the sellers do strengthen their control of the market, it's possible the price may reach the lower line of the channel, and Citi's forecasts are around these areas, and they are that it'll be $73 per barrel by the second quarter of 2024. And in fact, $68 per barrel at the end of 2024. So quite a decrease, in fact. And, we've been talking about oil for a long time. So inflation relies on energy prices as well. Could be good signs for the economy as a whole. And certainly some of the US economy would welcome with open arms. But as ever, these things can change, particularly with geopolitical concerns. So don't forget your risk management techniques. We wish you luck for your week trading ahead. Bye for now.